Ladies and gentlemen, I thought we were done with this. Trade deals moving off the table, stocks slipping, Trump back in villain mode. We were promised trade deals and all we got is one deal with the UK. I swear, the only thing that'll save us right now is a rate cut. Jerome, listen to me. You better cut next week, bro, or the FinFluential army is pulling up to the Fed building. We know where you work. This isn't a threat, it's a promise. Cut those rates. Please and thank you. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks moved higher on Thursday as President Trump again urged the Fed for a jumbo rate cut amid easing inflation pressures despite renewing take-it-or-leave-it tariff threats from trading partners. And guys, it was a broadly green day. I feel like that has been the theme of this week. We've had slight green days that are building up towards those all-time highs in the S&P 500. But what weighed on the market today was comm services as a whole. This entire sector was actually kind of red, led by Google, Meta, but the telecoms as well, Netflix, Disney. This entire sector broadly red. Credit services and diversified banks also weighed on the market, especially in the financial space. Tesla, for some of the mega caps, was down 2%, the worst performing of the Mag 7. And then we had GE Aerospace and Boeing, both down 4% and 2% after there was a plane crash in India where 245 people died on a Boeing plane. And that is why those stocks were down in a very big way. But other than that, the market was fairly green. Nvidia gained, AVGO gained, Microsoft gained. Healthcare was very, very bullish, and it was one of the best performing sectors today, up 0.78%. We also saw the tech space up 1% despite what we saw with Google and Meta. Nvidia, Microsoft, and those names really held it together for the tech space. And then utilities was up 1.21%. And that's because there's been a bit of AI rhetoric, particularly as it pertains to energy and the needs for energy. That discussion has been ongoing. That is why utilities was up today. But the best performing asset class was gold, up 1.24%. And again, when you have these tariff threats lingering, gold is going to do very well in that type of environment. Other sectors that performed really well today: staples, real estate, materials, with the S&P 500 up 0.4%. So a solid day in aggregate, especially considering how we started the day off. We were deep in the red, and then the S&P 500 came back to finish positive on the day. Again, detractors for the market was stuff like financials, industrials, XLY, consumer discretionary, and then communication services being the worst performing sector. It was a very bifurcated day. We saw small caps really take it on the chin. Mid cap growth was kind of flat, but every other factor and size segment was red. Large caps, by and large, were actually very green, and then core and value and mid caps were very green. Very, very mixed day, in the US markets, but also globally. You could see here that North America is very green. Europe kind of mixed, mostly red. Asia, definitely mostly red. Both China, India, Australia, Southeast Asia, very red here in the Asian segment. And generally speaking, that's why we saw Europe red as well. They say as goes China, so goes Europe. But the S&P 500 actually staged quite a comeback. You could see right here that the market was very red, down 0.6% coming into the day. However, we then actually made a move higher, finishing up 0.25% on the day. This does include after hours price action. We were up 0.4% in regular trading hours. And that's because the reason why it's had to do with some tariff headlines. Vietnam's trade minister met with Nike and Walmart executives to rally support ahead of a possible 10% tariff or more, depending on the rate Donald Trump sets. The Vietnam warned Nike of supply chain disruptions and urged Walmart to build a hub in Vietnam. They believe $57 billion in exports is at stake. Now, the market did not like this headline at all. Also, Donald Trump came out and said that unilateral tariffs will be set within 2 weeks. And when you get that dichotomy, markets are going to sell off. However, Scott Bessent came out, saved the day, and he said highly likely that the tariff pause would be extended for countries that are negotiating with the administration in good faith. That's the key word right there, in good faith. And right now, that is China, that is Japan, and that is the European Union. And ultimately, those are the trading partners we really, really want to worry about. So this is why markets sort of like put in lows and finished positive on the day, because, Scott Bessent being the man of reason, saying, look, if you are negotiating in good faith, we can actually extend that tariff pause. In terms of economic data, this kind of did move the market, but the CPI is what really moved the market. PPI came in as expected on the month-over-month figure, as you can see right here, but the core figure came in slightly hotter than expected. The actual came in at 0.1. The forecast was for negative 0.1%. And then initial jobless claims actually beat expectation, 250,000 versus 240K reported. Very, very solid stuff. Now, when we look at some market movers, Oracle up 13% today, and that's because it reported its earnings. It had a double beat. It actually raised guidance, very strong guidance. We're looking at like 50, 60, 70% year-over-year growth for some of its segments, doubling its compute capacity, doubling its data centers, doubling its cloud platform. Yeah, absolutely stellar earnings. If you want the full scoop, you can actually go ahead on my second YouTube channel, FinFluential Media. I'll leave it in the description below. You can go ahead and check out my full earnings, a deep dive on Oracle, and is it a buy right now? My fair value, everything's right there. Now, a company that reported earnings today is actually Adobe. Now, this was absolutely insane. They beat on the top line, beat on the bottom line. Revenue grew 10% on a year-over-year basis. Management actually raised guidance ever so slightly, and the stock is flat here in the after hours. I mean, absolutely insane when you think about it. I mean, the stock should be up like 7 or 8% on the back of this news, but the stock has been a little bit of a dog. Nonetheless, this could possibly provide opportunity, and we're going to talk about Adobe in today's video. So FinFluential Media, about an hour after the upload of this video, you're going to see a video discussing Adobe as a whole, because this is getting really, really interesting. I mean, look at the trailing 12-month PE ratio, 21 times. It's probably trading at like 17 times forward, maybe 16 times forward. Very, very attractive. So we'll talk about it. And then IPO season is back, baby. I mean, Chime Financial IPO'd at $27 a share. It was up 40% today at $37 per share, guys. I think this stock is going to go on a bit of a run, very similar to what we saw with Circle, very similar to what we saw with CoreWeave. But this business isn't as high quality as the other two IPOs. That being said, this is really, really good. If you see this type of price action, it means more IPOs are likely on the market. And hopefully we'll see Sheen. Hopefully we'll see Stripe. Hopefully we'll see a bunch of other IPOs come. Hopefully we'll see a bunch of other IPOs for the remainder of 2025. And then for everything we saw today, guys, there was 2,800 advances, 3,300 decliners. We saw net inflows in the New York Stock Exchange, outflows in the NASDAQ 100, and then market momentum looking a little bit shaky here at the 5-day, but the 20, 50, and 100-day looking very, very solid, particularly the 50-day, and then the 150-day and 250-day continue to be at that 45% level. Not much changes from yesterday, definitely up from last week as a whole, as you can see this number compared to this number. But if the market wants to retake those all-time highs, we need market breadth expansion, and we need a 50% reading in the 200-day and 150-day moving averages. Everything else looking really, really good. I do take into consideration the 5-day is a little bit noisy, but this is concerning. Even though the market is moving higher, average stock has fallen below its 5-day moving average, and that could mean that we are seeing, sort of a rotation from these smaller names in the market into the large names, which are holding up the market by and large. But let's hop on the charts. Looking at the charts, a very mixed day, but not so positive here in small caps, the IWM, but they've been completely outperforming their large cap counterparts in the last 2 weeks. So to see a little bit of a pullback, a little bit of a breather, totally to be expected. I would just look at it like that. We did see the S&P 600 fall, but mid caps actually held it in there, all things considered. But yeah, really a day just for large caps and the S&P 500 by and large. You could see RSP performed in line with the NASDAQ 100, and the S&P 500 outperformed relatively speaking. A very solid day for US equities. China stocks fell a lot, down 2.5%. European stocks also fell. The US was really the place to be today. And then volatility ticked up ever so slightly, but still fairly compressed here in the high teens level. And then the 2-year, 10-year, and 30-year yield continue to fall. Guys, the 10-year yield went from literally like 4.6, 4.7% to now at the 4.3% range. The 2-year yield officially below that 4% level. I think the market really starting to price in potentially a rate cut next week. I mean, that's generally what happens when yields move low. It's sort of the market pricing in a potential rate cut or rate cut expectations ramping up next week. I really think with all the pressure we're seeing from Trump, Vance, Bessent, this administration, I think probably Trump is going to cut tomorrow. Market expectations are still for a 50-50%. So they're still not completely convinced. What is interesting though is that the dollar is now officially below the 98 level. It fell 0.74%. The dollar being very, very weak, and that's going to continue until this budget bill is passed. Once the budget bill is passed, this big beautiful bill, we'll see strength in the dollar. And then the AGG bonds, TLT, they were up. And again, that happens when yields fall. TLT went from the $80 range, $81 range to $87. I mean, very, very solid momentum right there. Bitcoin was down 2.31%. So we continue to see consolidation, very ugly price action for Bitcoin. Gold was up, silver was up, WTI was up. Let's talk about the S&P 500. And guys, we've said this for the last couple of days now. If we don't get some very, very solid news and a catalyst that could take us back to those all-time highs right here, we probably will see a little bit of resistance at these levels. And that tends to happen in the back half of June. The last 2 weeks of June tend to be negative seasonally. So unless we actually get like a really big announcement and a really solid trade deal from the China situation, maybe from Japan, from Europe, do expect a little bit of volatility to occur at these levels right here. But if we do get that big news event from Trump, from whoever, that can push us to all-time highs. And that's what it's going to take to push us to all-time highs. Otherwise, we're probably going to continue to trade in this level right here. And I wouldn't really be adding longs at these levels. I'd probably wait for a pullback to these lower levels before you go ahead and go from there. That being said, equities for the most part, if you look at the weekly chart, the US equities look very, very strong off these lows. You see a huge impulse to these all-time highs. We made a pullback, and yes, we did break some of these key levels, but we put in an equal low right here and ripped to the upside very, very strongly. The price action at the top end of this range right here, it's not super convincing. Like I said, we are seeing a little bit of resistance that is going to happen after what is a 20%, 25% rally off the lows. But as long as we hold this level right here, that would mean a higher low for the S&P 500 to take us, back to all-time highs. And if we put in a higher low, break these highs, that would just signal trend continuation, exactly like we saw here. We put in a low, we rallied up, pulled back, put in a higher low, rallied above that, trend continuation. If we just do that, right, we would just simply be mimicking what we would normally be doing in a typical trend. And that's higher highs, higher lows, back to all-time highs. And that's ultimately what we want to do. Now, the NASDAQ 100, very similar situation. You could see here's the all-time high. This is where we are right now. Very solid trend continuation. We're seeing a little bit of resistance here at the top end of the range. And again, that's to be expected unless we get something big from this administration. Now, something that can move the market next week, the catalyst, the FOMC. We get a rate cut next week. That's pretty much all-time highs guaranteed for the S&P 500, for the NASDAQ 100. That probably means we go ahead, retake this 2200 level in the RTY and go from there. If we look at European stocks, it does look like we're sort of forming like a double top and a lower high. That is not constructive in my opinion. Really, ultimately, if you were a bull, you wanted European stocks to go ahead and retake these all-time highs, but that's because earnings expectations for European stocks haven't hit all-time highs just yet, and that is why we're seeing the dichotomy we are. Whereas if you look at S&P 500 earnings per share, we're at $280 in earnings per share. At the Liberation Day sell-off, we were looking at $279. So earnings per share expectation for US stocks continue to march higher, and that is why we're seeing pretty much the S&P 500 slowly march its way up to all-time highs, where it does look like European stocks are starting to roll over. We're seeing a lot of volatility here at the top end of this range. When you look at the S&P 500, we're not seeing as much volatility. We actually continue to just make, I guess you could say, cyclical highs in this area. But we really need a slew of rate cuts next week or really strong tariff announcements, trade deal announcements to take us higher. Otherwise, I do see a little bit of downside here for the S&P 500. But any downside would simply be a buying opportunity, in my personal opinion. I do think we probably will go ahead and eventually retake those all-time highs before this year is up. Let's quickly have a look at gold, guys. You know exactly what we're doing with gold. We're trading this range until we actually get a breakout above or below. And it does look like that's actually what we got today. Gold up just shy of 1%. It looks like we're officially breaking out above this sort of like triangular wedge. We'll see what happens in tomorrow's trade. Let's have it play out, because if it does play out, what we could do is probably adjust this to something like that. That would probably be a better adjustment if that is the case, if we do see a little bit of resistance. However, if this continues to go ahead, make another high, and we approach these highs right here. So for example, this is where we are right now. If we approach these highs right here, then this would officially be a breakout, and then we could go target these highs, these all-time highs, and then potentially the 3600 area. But we need to watch what happens here with gold over the next couple of days. But personally, I'm not long gold. It can go up, it can go down. I'm unfazed. I am long Bitcoin, however, and even though Bitcoin was down 2% today, what you guys have to understand is that the trend continues to the upside here for M2 money supply. When you offset global M2 money supply, it sort of gives us the path for Bitcoin in the future. And look at what just happened. We made another all-time high in global M2 money supply. Guys, do not be shaken out by this price action here in Bitcoin. It is a volatile asset, but onward and upward, we will go ahead and retake something like the 130,000, 120,000 in Bitcoin. We will go ahead and hit an all-time high there. We're just sort of digesting a little bit of this move that we saw to the upside right here. But M2 money supply is telling us we will go higher. And once this budget bill comes to fruition, that's more fuel and more power for Bitcoin to move higher. So don't be shaken out. Follow the process, and the plan is we do go higher. And again, if you just move Bitcoin, you can see that this pullback here was to be expected. It's exactly what we expected was going to happen for Bitcoin by and large. Now let's go ahead and quickly talk about some individual stocks that I do like. Firstly, Evolution AB. This is a European stock in the gambling space. It's sort of putting in a low right here. We said that this is a great place to go ahead and buy. I was building a position in this stock. I have an average buy price of about $75. I was buying a lot right here. And after earnings, the stock moved down. Did buy a little bit right here. And I think we probably are going to go ahead and close this gap at the 86% range. The stock was up 1.42% today. It was also up yesterday in a very, very big way. And, really off these lows, it's up 5% in the last couple of weeks. So very, very strong momentum off the lows. And I do think we're going to go higher. Another stock that I really do like, I also own as well, is Meta. Now, even though it does look like it's rolling over right here, if we do get a pullback to the 630 area here for Meta, this is a buy. Let's say this is a very, very strong candidate for Meta to go ahead and buy. Earnings expectations are still at all-time highs and higher every single day for Meta. So we will go ahead and retake those highs. If we do get a pullback, buy this dip and look for trend continuation for us to go ahead and retake those all-time highs. It will happen just in due time. So if we do get a pullback, this is the golden opportunity for you guys to get in, get long on Meta, and then go from there. And guys, diving into sentiment, this is the III sentiment survey. And over the last couple of weeks, we've officially seen sentiment flip bullish after the tariff liberation day lows, 36.7 versus 33.3% here on the bullish side. Now, look, this isn't like a glowing recommendation to get long because sentiment is bullish. This is just an indicator telling us that in the next 6 months, the market is generally more optimistic. In fact, the fact that we are seeing these levels right here is probably a reason for us to get a little bit cautious. And when we do look at the median 2-week returns for the S&P 500 going into the second half of June right here, you can see that we actually should expect negative returns over the next couple of weeks. So if we see a little bit of a pullback in the market, it is seasonally normal. That is what has happened since 1950. So even though bullish sentiment looks really, really good right now, guys, take that with a grain of salt. Seasonally, we're going into a weak period in the year. And oftentimes when sentiment gets as bullish as it is right now, we do see a little bit of a pullback, a reset of expectations, wipe out those weaker longs, and then we can move higher, onward and upward from there. And if we look at the long-term picture, this is from Fundstrat's Tom Lee. I know it's not the best picture right here, but Tom Lee outlines 5 reasons to favor a new bull market. Number 1, he says the ISM is still below 50, more consistent with early cycle. The housing deficit this cycle, 1.7 million shortages of homes versus the past decade. The New York Stock Exchange FINRA margin deck declined by $90 billion since January, not consistent with the top. That's very, very true. He believes III sentiment is not quite yet at the top and we can actually move higher. And he believes that this is still a very, very hated rally. And so with these 5 points, Tom Lee believes you should favor this new bull market. And obviously he's talking in the long term, 6, 12, 18 months down the line. Whereas what we're talking about here is more of a 2-week setup. So we could see a little bit of short-term consolidation, short-term pain, but longer term, everything is intact for us to go higher. We know that Q2, the GDP, the Fed GDP now, still sitting at about the 4% mark, just shy of 4%. Very, very strong and robust figures. Something else supporting this market, mortgage applications ticked up in a very big way in yesterday's data. Something we didn't cover in yesterday's video. Very, very solid to actually see this, right? However, we do have to look at both the good and the bad. And something we are seeing is that this suggests that those unemployed might face hurdles in re-entering the workforce, potentially nudging the unemployment rate upward in the coming months. And this is jobs plentiful minus jobs hard to get. Generally, when this moves in a downward direction, we do see the unemployment rate tick up. It might not be in a material way, but we can see it tick up. In terms of tomorrow, we just get University of Michigan sentiment in terms of data. All of the big data is behind us, and we don't really have much of anything when it comes to earnings. So if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.